It's comforting as a shareholder to know the SEC is looking at that, and maybe a little bit nerve-wracking as a public company to know that the SEC is taking a closer look at that.
Well, it really is, Catherine. I would point out that whenever you have an accounting error, generally the error itself is fairly easy to fix, but it's having to go through this control analysis, the what could have gone wrong. Usually that's the part where most of the pain comes in. Hello and welcome to Off the Books, where we surf the uncharted waters of accounting, finance, risk, and wherever else the waves take us. This episode is brought to you by Workiva, the one platform that unites financial reporting, ESG, audit, and risk teams, because who really needs any more division in this world? My name is Steve Soder, accounting enthusiast and Diet Coke aficionado, looking forward to debating a great conversation, and I'm so happy to have you with us. I am also, as always, very happy to have Catherine Sy joining us. Catherine, can you please tell the fine folks who you are?
I'm not an accountant or Diet Coke aficionado, but I like venti soy chais and asking questions, so I'm here to do more of that.
Well, what do you want to ask today on the topic of questions, Catherine?
Well, you and I both attended the Q1 SEC Professionals Group meeting where former SEC Regional Director David Peavler was speaking, and I had some follow-up questions.
Well, I'm happy to debrief it because it was a fantastic session. We've done a few things with David from the pro groups over the years. Every single one of them has been phenomenal, and this meeting in Dallas was no exception.
Great, because I want to ask you some more about it.
Well, I bet our listeners want to learn more about it, so let's get going.
Sounds good. And one hot topic was the SEC's new pay for performance or pay versus performance rule. I don't have much background on that, so can you fill me in, Steve?
Yeah, that's not a problem. So basically, at a super high level, and I'm oversimplifying here, what the SEC was trying to do was be able to attach executive compensation to the metrics that a company uses in order to determine that compensation. So profitability is a really good one, or growth in stock price would be another one. Up to this point, those kinds of disclosures were limited a little bit, and so what the SEC was really trying to do was break it out into more clarity to say, hey, look, pick 3 metrics that drive that kind of compensation, and then disclose what an executive is actually paid and how that matches up to those metrics. One of the things that we did talk about with David, though, is that some of those metrics aren't actually GAAP information potentially, so U.S. generally accepted accounting principles, basically the rules of the road when you look to external public reporting, financial public reporting. And so the question that we had for David is, what if a company is using a non-GAAP measure as one of those metrics, but then maybe that same measure was included elsewhere in a 10Q or a 10K, for example? Could there be some kind of issues if maybe those two metrics were calculated just a little bit differently, or the disclosures around those metrics might be different?
Let's hear what David had to say.
What that does is introduces a potential area for the SEC to come in, look, and say, are you applying that consistently year over year? Have you defined it in a way that is clear and consistent over time? And have you made changes to it that have the effect of benefiting the executives?
Now, as you can tell, Catherine, David didn't make a judgment on that particular issue right there on the spot, but I did think he shared some really good advice on just non-GAAP metrics generally.
That sounds good. I'm curious if that would change any sort of conversations that you would be having with the board about compensation if you were the controller of a company.
Well, I think so. I mean, part of it is to be sure that obviously the metrics that are tied to executive pay are aligned with, I would say, the metrics for companies as a whole, including what the board thinks are important. One of the things that I think can happen that gets companies in trouble is if metrics that are being used specifically for compensation aren't necessarily aligned with the company as a whole or maybe the board's interest. And to the extent that those two things are misaligned, you could actually have an executive team focusing on something that might be very different than what the board would have them doing.
Okay. Well, speaking about non-GAAP measures, David referenced the SEC filing charges against a company that was accused of making non-GAAP adjustments having to do with expenses and costs without the right controls to make sure it was following its own description of how it was determining what was an expense versus a cost that could be excluded from a net income number.
Yeah, he sure did. And it's actually a really good point, is that if you are going to be using these non-GAAP metrics, whether that's for executive compensation or just as part of your earnings release or something you'd find in a 10Q or a 10K, the disclosure controls around that is so important, because you could imagine it could be advantageous for a company to maybe just make up some of these non-GAAP metrics in order, for example, to make that quarter look a little bit better. And yeah, this issue recently came up on an enforcement case from the SEC, and we can hear what David had to say about that.
The one common theme that you see running through the SEC's enforcement and rulemaking is when information is reaching shareholders, the SEC is going to expect that there is good process behind it, that there is good disclosure around it. And I don't think they're going to draw those kind of fine distinctions, well, it was in this document versus that document. I think they're going to look at it as this is an information is being provided to your shareholders.
You know, Catherine, that actually led to a discussion that we had with David at the session about internal controls and just how important it is to have the right procedures in place. He actually brought up a recent case where it wasn't so much about anything that actually went wrong, but even more focused about what could have gone wrong. And that's a pretty common theme when it comes to having to unravel any issues surrounding internal controls.
Let's hear what David had to say.
Some of the messages we've gotten from the Division of Enforcement at the SEC over the last couple of months, as I mentioned, they're using some rules that we didn't used to think of as being standalone kind of rules. And in particular, I'm thinking of the disclosure controls and procedures, the DCP rule, which used to be a tag-along to fraud or some other misrepresentation claim. It was a non-fraud, non-scienter, non-intent charge that, well, a company has made a misrepresentation and the SEC is adding this because clearly they wouldn't have made the misrepresentation if their DCP was any good. We saw about 6 weeks ago or so in the Activision case, the SEC actually made a standalone DCP case, even in the absence of a misrepresentation, but really focused in on how the people who are responsible for making disclosure decisions are getting information. And so to take your example, something that winds up in a proxy that is a metric that the company is using and that is being communicated to investors, the SEC has at least signaled the intent to look at how that metric is generated. What are the information gathering processes, the decision-making processes to ensure that all the right information is winding up into this metric so that it's accurate. And even in situations as in the Activision case where the SEC doesn't say any particular Activision disclosure was misleading, they still faulted the process. And I think that's kind of where the SEC is kind of drifting, is that the process is as important almost as what comes out of the process. And so I would say that yes, to the extent you're putting something into a disclosure, there has to be solid process behind it and ensuring that it's at least reliable from the company's perspective.
Catherine, I'll note as those on YouTube are actually seeing this video, I think they may see this video, I'm really glad that David and I were sitting down because the contrast in our height, as you noticed at the live event, could not be more dramatic. So anyway, I'll just point that out. But one of the things that's actually really interesting that David is talking about is the fact that anymore in accounting, it's not just about getting to the right number. How did you get to the right number? And the controls for both of those have to be just as robust. Again, not just the fact that you had this disclosure and that it was correct, but did you go through the right processes? And actually, speaking of David, one of the events that we had him on a number of years ago was him talking about Enron. And I think that Enron, having resulted with other corporate scandals, of course, having resulted in Sarbanes-Oxley, was all about that issue. How did you get to the right answer? And do you have the right controls and procedures in order to assure that you could have not gotten it wrong? Or basically the inverse, hey, what could have gone wrong had those procedures broken down?
It's comforting as a shareholder to know the SEC is looking at that, and maybe a little bit nerve-wracking as a public company to know that the SEC is taking a closer look at that.
Well, it really is, Catherine. I would point out that whenever you have an accounting error, generally the error itself is fairly easy to fix, but it's having to go through this control analysis, the what could have gone wrong. Usually that's the part where most of the pain comes in.
Well, Well, we couldn't let David go without asking him about the SEC's proposed climate disclosure rule, but before we get to that, let's take a quick break for a commercial. How is a financial reporting team better than a dad joke? A dad joke can tell you what to call a busy accounting leader, but it's not going to tell you why. Really good financial reporting teams can pull together reports that tell you what happened last month and even tell you why. They just don't always have time to get to the why. That's where Workiva comes in. Top accounting and finance teams are using the Workiva platform to automate financial reporting, from financial statements to board reports, from 10Qs to S1s. Spend less time copying and pasting numbers and more time telling the story behind the numbers with data your auditors can trust. See why accounting and finance teams love Workiva at workiva.com/accounting. That's WORKIVA.com/accounting. So what do you call a busy accounting leader? Overtaxed. Ugh. Why?
And we are back. Catherine and I were catching up on comments by former SEC Regional Director David Peavler, who is now a partner at Jones Day, and he was talking to us at the Q1 SEC Professionals Group meeting.
And of course, a question came up about the SEC's proposed climate disclosure rule. David did predict that the SEC's climate disclosure rule will probably end up in court.
Yeah, he absolutely did. Opponents have raised quite a few questions about the SEC's moves here around climate disclosures, and here's what David had to say.
There's a real question of whether the market will fix itself, through demand from investors, through competition. In other words, if you have one company who discloses almost nothing about their climate change risks, and another company that provides a pretty fulsome and reliable and well thought out set of disclosures, which one is going to draw more investment dollars? If the market says we value that information, presumably the market will go to that company with the more fulsome disclosures. And so the question becomes is, do you then need to lay on top of that some mandated disclosures?
So David was suggesting that there's probably going to be a party that's going to bring this up in court, and perhaps this matter ends up getting legislated by Congress versus being handled by regulators.
Yeah, and there was even chatter in the room, Catherine, as you heard, among SEC Pro Group members about whether it's even lawful for the SEC to be making these rules under their current mandates from Congress. I would just point out, I think David does make a really valid point. If the market is going to reward those companies that are making those fulsome investors, then why couldn't the market just take care of itself? And I do think that's an important element to what's happening here. I think the counter argument to that, though, is that how do you ensure those disclosures are consistent? I mean, yes, maybe over decades, perhaps everything sort of aligns, much like it did with accounting. But I do think that if you were to talk to maybe analysts or investment companies that actually are using this information, they would tell you that it's a real challenge to compare one company versus another when, number one, the disclosures may be inconsistent, but number two, there may be no assurance provided around that. Again, assurance might be something that the market solves, but I think people are trying to move, at least the SEC in this case, are trying to move to resolve those concerns a little more quickly.
And based on what I heard at the meeting, it sounds like there is some room within the law for the SEC to step in and propose this climate disclosure rule because they're trying to adapt with the times, and the law allows for that.
Yeah, I think so. I mean, if you listen to SEC Chair Gensler, he will always talk about the fact that investors are asking for this information. And as far as he is concerned, if the market is demanding this kind of disclosure, then it is well within the SEC's purview to be requiring it.
I also liked how you kind of snuck in a closing question for David at the meeting. Do you remember that?
Yeah, hey, full break here. I actually don't remember what the question was. I'm sorry.
I think you asked him, what was his, a key takeaway or biggest takeaway from his career at the SEC?
Oh, that's exactly right. And now I kind of hope we don't edit this out because, that's just me forgetting what I'm talking about. This happens all the time. No, that's absolutely right. David has spent a ton of time at the SEC, and he has seen, I'm assuming, just so many, maybe from the mundane to just the craziest things out there. For our audience, David spent pretty much the time in his SEC in enforcement, which is when a company has done something wrong, and the SEC is not just asking questions like, hey, explain what you meant by the disclosure in the 10K. It's like, hey, you have broken securities rules, and now we need to have some kind of a criminal investigation. it just occurred to me how interesting David's career has been, and that he's probably taken away just a ton of interesting learnings, I would say both on a professional and on a personal level, and that's what I asked him about.
One of the biggest takeaways I got from a long time of looking at a lot of different companies and a lot of different misstatements situations is the vast majority of them did not start out as intending to cause harm or to intending to commit fraud. Some of them did, and a lot of those people are in jail still. But the vast majority of them started out as a mistake. It started out as we did this wrong, or we made an error this quarter, and we don't want to admit it. And there is, I think, a sense of the groupthink maybe of being able to convince yourself, well, we're going to fix it this next quarter, or we're going to do something that's not entirely correct this quarter to fix that mistake so that we don't have to admit it. And what invariably happens is it gets worse, it gets worse, it gets worse. And then at some point it crosses that line from mistake into fraud. And what I would say is when you find yourself having to justify a mistake, just admit the mistake. It's the old line of it's the cover-up is worse than the crime. That really is true, and that's something I saw play out over and over. So, when you run into those situations, it's always better to admit the mistake than to try to fix it.
He's got such great advice there. I mean, fortunately, I was never in one of those situations where, we were anywhere near those kind of considerations. But it's true. You're all in a room, you're looking at the fact that the company had forecasted guidance, or you have a budget or something like that, and you miss it. Or maybe there was some kind of error. And it seems like for a split second, it's like, well, is there anything that we could do, maybe to get over that? And I really like what David had to share. Universally, at least in my limited experience, not having seen that probably as often as David has, it is always better to admit the mistake and move on rather than just perpetuating it, because at some point, obviously the bill comes due, as they say, and generally those can have, at least in some cases, pretty disastrous consequences. I don't know, Catherine, how did you interpret his comments?
I thought it was fascinating, and I think probably one of my favorite parts of being at that meeting was getting to talk to people afterwards and also getting to listen to more of what David had to say in the SEC Professionals Group chapter meeting. So, I mean, if you are an accountant, if you are an SEC reporting professional, definitely join the SEC Pro groups and try to go to those in-person meetings, because it's great to hear what people have to say afterwards.
You know what? I couldn't agree more. I've been privileged to be an active participant in the SEC Pro Group for a big chunk of my career, and it's those conversations, right? It's that dialogue. Well, how are you solving this, or what are you thinking about this? Or, of course, even the social interactions that have been extremely rewarding for me. So I couldn't agree with you more. I bet the other thing you appreciated about that, Catherine, was the, 6 Diet Cokes I think I drank while we were waiting for the Uber back to the airport?
That's right. Fascinating.
Well, thank you, Catherine, and thank you, dear listener, for surfing along with us. I'm Steve Soder, that was Catherine Tsai, and this has been Off the Books, presented by Workiva. Please subscribe, leave a review, and tell your buddies if you like the show. Now, if you're watching this on YouTube, we would love it for you to leave us a note in the comments. Maybe tell us what reactions you had to what David had to share. Or you are also always welcome to drop us a line at offthebooks@workiva.com. Surf's up, and we'll see you on the next wave.